Here's a question that might keep you up tonight. Why do billionaires keep getting richer even when markets crash, businesses fail, and entire industries collapse? It's not luck, it's not insider information, and it's definitely not because they work harder than everyone else. The ultra-wealthy share a specific mental framework for making decisions, one that almost nobody teaches in schools, universities, or even business programs. By the end of this video, you'll understand exactly how they think, why it works in every single market, and how to start using it yourself starting today. Let's start with a story about a guy named Jeff Bezos back in 1994. He had a comfortable job at a hedge fund in New York, making great money, living the dream. Then he got this wild idea about selling books on the internet. Now, most people in his position would think about this decision in a pretty straightforward way. They'd ask themselves, should I quit my stable job to start this risky business? Yes or no? Stay or go? Safe or dangerous? That's how normal people make decisions. They see two doors and try to figure out which one is less scary. But Bezos did something different. He used what he later called the regret minimization framework, which sounds fancy but is actually dead simple. He projected himself forward to age 80, sitting in a rocking chair, looking back at his life. Then he asked himself one question. Which decision would he regret more? Would 80-year-old Bezos regret leaving a cushy Wall Street job to chase this internet thing? Probably not. Even if Amazon failed completely, at least he tried. Would 80-year-old Bezos regret never trying at all, watching someone else build the online bookstore empire? Absolutely. That regret would eat at him forever. So the decision became obvious. This is the first glimpse into how wealthy people think differently. They don't just weigh the immediate risks and rewards. They think about decisions across time, across multiple possible futures, and across the full range of potential outcomes. But here's where it gets really interesting, and where most explanations of wealthy thinking stop short. The decision-making trick that ultra-rich people use in every market comes down to one concept that sounds complicated, but isn't: expected value. Don't worry, this isn't going to turn into a math lecture. Expected value simply means looking at all the possible outcomes of a decision, figuring out how likely each one is, and then calculating what you'd get on average if you made that same decision 1,000 times. Here's an example. Imagine someone offers you a bet. You flip a coin, and if it's heads, you win $200. If it's tails, you lose $100. Most people would hesitate. Losing $100 sounds painful, but wealthy people would take this bet every single time without blinking. Why? Because the expected value is positive. Half the time you win $200, half the time you lose $100. On average, you make $50 every time you play. If you played this game 100 times, you'd expect to walk away with roughly $5,000 in profit. This is how the ultra-wealthy approach every decision in every market. They're not asking, could this go wrong? Of course it could go wrong. Everything could go wrong. They're asking, what's the expected outcome if this plays out across many scenarios? Warren Buffett, whose net worth hovers somewhere around $130 billion, has talked about this extensively. He doesn't look for investments that are guaranteed to succeed. He looks for investments where the potential upside, multiplied by its probability, vastly exceeds the potential downside multiplied by its probability. That's expected value thinking in action. But here's where it gets even more powerful. The real trick isn't just calculating expected value, it's understanding asymmetric opportunities. That's a term worth breaking down. An asymmetric opportunity is one where the potential upside is dramatically larger than the potential downside. You're not risking $100 to make $100. You're risking $100 to potentially make $10,000. Consider how venture capitalists operate. A typical VC fund might invest in 30 companies, knowing full well that 20 of them will fail completely. Total losses. Gone. Another 8 might break even or return small profits, but those last 2, those might return 50 times or 100 times the original investment. One massive winner pays for all the losers, and then some. To normal people, this sounds insane. Who would knowingly invest in things that are likely to fail? But to expected value thinkers, it makes perfect sense. Peter Thiel invested $500,000 in Facebook back in 2004 for roughly 10% of the company. When Facebook went public, that stake was worth over $1 billion. Did Thiel know Facebook would succeed? No, He knew the odds were against any individual startup, but he also knew that if it worked, the payoff would be so enormous that it would dwarf any losses from failed bets. This brings up another crucial element: position sizing. That's the fancy term for how much you bet on any single decision. The ultra-wealthy don't bet everything on one opportunity, no matter how good it looks. They size their positions so that if they're wrong, and they will be wrong sometimes, they live to fight another day. Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund, built his fortune on what he calls the holy grail of investing, holding 15 to 20 uncorrelated assets that don't move together. Why? Because confidence isn't certainty. Everyone has blind spots. The market does things that nobody predicted. By spreading positions across truly independent investments, Dalio ensures that no single mistake can wipe him out. This is something most people get catastrophically wrong. They find one stock, one crypto coin, one business opportunity that feels like a sure thing, and they go all in. When it works, they feel like geniuses. When it doesn't, they're devastated. The wealthy don't play this game. They spread their bets across multiple opportunities, knowing some will fail, and structure their positions so the winners more than compensate for the losers. There's actually a mathematical reason this works, discovered by a physicist named John Kelly back in 1956. Kelly was trying to figure out how much a gambler should bet when they have an edge, when the odds are slightly in their favour. His formula, now called the Kelly criterion, showed that betting too little leaves money on the table, but betting too much leads to ruin even when you have an advantage. The Kelly criterion demonstrated something counterintuitive. Even with a 60% chance of winning a bet, if you bet everything every time, you will eventually go broke. The math is brutal and unforgiving. Wealthy people understand this instinctively, even if they've never heard of John Kelly. Let's get really practical now. Expected value thinking doesn't just apply to stock markets and startup investments. The ultra-wealthy use this framework for literally every significant decision they make. Hiring employees, choosing business partners, deciding which markets to enter, even personal life choices. Take Elon Musk's decision to start SpaceX in 2002. By his own admission, he thought the company had maybe a 10% chance of success. Most rational people would look at those odds and walk away. But Musk did the expected value calculation differently. The downside was losing the $100 million he planned to invest, a huge sum, but not everything he had after selling PayPal. The upside, revolutionizing space travel, making humanity multiplanetary, and building a company potentially worth hundreds of billions. When you multiply a 10% chance by a truly astronomical outcome, the expected value becomes enormous even with a 90% chance of total failure. This is where most people's brains break. We're hardwired to avoid losses. Psychologists Daniel Kahneman and Amos Tversky won a Nobel Prize for demonstrating something called loss aversion. The finding that losing $100 feels about twice as painful as winning $100 feels good. This wiring made sense when humans lived on the savannah. Losing your food supply meant death. Taking risks rarely paid off enough to justify the potential catastrophe. But modern markets don't work like the savannah. In today's world, the downside of most decisions is capped. You can only lose what you put in, while the upside can be virtually unlimited. Wealthy people have trained themselves to override the loss aversion instinct. They've learned to tolerate the discomfort of potential losses in exchange for positive expected value. Charlie Munger, Warren Buffett's longtime business partner, calls this inverting the problem. Instead of asking, how can this succeed, he asks, how can this fail? He makes a list of everything that could go wrong, assigns rough probabilities to each scenario, and only then decides whether the opportunity is worth pursuing. This sounds pessimistic, but it's actually the opposite. By honestly confronting the ways things could fail, Munger can make confident bets when the expected value is genuinely positive. Now here's something that separates the truly wealthy from everyone else. They understand that expected value calculations change based on information. Every market, whether it's real estate, stocks, cryptocurrency, or even job markets, has information asymmetries. That means some people know more than others. The ultra-wealthy obsess over gaining information advantages because better information leads to better probability estimates, which leads to better expected value calculations. This is why wealthy people spend enormous amounts on education, advisors, research, and networks. When Carl Icahn takes a position in a company, he's not guessing. He's spent millions on research, lawyers, and analysts who have examined every detail of that business. His expected value calculation is based on superior information. Meanwhile, retail investors are making the same bet based on a headline they read and a gut feeling. Mark Cuban has said repeatedly that the single best investment anyone can make is in their own education, specifically learning about the industries and markets where they plan to operate. This isn't feel-good advice. It's expected value thinking in action. The more you know, the more accurate your probability estimates become, and the better your decisions get. But there's a trap here that catches a lot of smart people. It's called overconfidence bias, and it makes people think they have information advantages when they actually don't. Wealthy decision makers are almost paranoid about this. They constantly ask themselves, what do I know that others don't? And if the honest answer is nothing, they either pass on the opportunity or size their position appropriately for a coin flip situation. This connects to another principle the ultra-wealthy live by: reversible versus irreversible decisions. Jeff Bezos categorizes decisions into two types. Type 1 decisions are irreversible. Once you make them, you can't easily undo them. Type 2 decisions are reversible. If they don't work out, you can course correct without much damage. Most people treat all decisions like Type 1 decisions. They agonize over everything, delay endlessly, and miss opportunities while overthinking. Wealthy people flip this script. They make Type 2 decisions quickly, knowing they can adjust later. They reserve careful analysis for Type 1 decisions, where the stakes truly justify the effort. Amazon's entire culture is built around this distinction, and it's a major reason the company moves so fast compared to traditional corporations. There's also the element of time in expected value calculations that most people completely ignore. $1 today is worth more than $1 next year because you could invest that dollar and grow it. Wealthy people discount future outcomes based on time, which changes how they evaluate opportunities. A 50% return over 1 year is wildly different from a 50% return over 10 years. The first is incredible. The second is barely beating inflation. This is why the ultra-wealthy often seem impatient with slow-moving opportunities. It's not greed or short attention spans. It's rational expected value thinking. Capital tied up in a mediocre investment can't be deployed to a better one. Every month spent on a low-probability project is a month not spent on higher probability alternatives. Here's the uncomfortable truth that makes this whole framework difficult to execute. Expected value thinking requires tolerating short-term losses for long-term gains. You will make bets that fail. You will look stupid sometimes. You will have periods where it seems like nothing is working. The wealthy understand this is part of the process, not a sign that the process is broken. Howard Marks, billionaire co-founder of Oaktree Capital, puts it perfectly. He says the goal isn't to be right all the time. That's impossible. The goal is to be right more often than you're wrong, and to win big when you're right while losing small when you're wrong. That asymmetry is everything. It's what separates people who build lasting wealth from people who get lucky once and lose it all. One final piece that ties everything together. The ultra-wealthy understand that the biggest risk is often not taking any risk at all. Sitting in cash feels safe, but inflation eats away at purchasing power every single year. Staying in a comfortable job feels secure, but industries get disrupted and skills become obsolete. Avoiding decisions feels prudent, but opportunities pass by and never return. The expected value of inaction is often deeply negative, but because there's no immediate visible loss, most people don't recognize it. The wealthy run expected value calculations on inaction too. They ask, what happens if nothing changes for the next 5 years? 10 years? If that outcome is unacceptable, they recognize that doing nothing is actually the riskiest choice of all. So what does all this mean for someone who isn't already wealthy? It means the game is learnable. Expected value thinking, asymmetric opportunity recognition, proper position sizing, information advantage awareness, decision categorization. None of this requires inherited wealth or special connections. It requires rewiring how you think about risk, reward, probability, and time. It requires tolerating short-term discomfort for long-term gain. And it requires practice, because these mental frameworks only become automatic after you've used them hundreds of times. The ultra-wealthy didn't become wealthy because they avoided risk. They became wealthy because they understood risk better than everyone else. They found opportunities where the potential upside dramatically outweighed the potential downside, sized their positions to survive inevitable failures, and kept playing the game long enough for the math to work in their favour. That's the decision-making trick they use in every market, and now you have it too. The difference between average decision-makers and the ultra-wealthy comes down to one thing: probability-weighted thinking. While most people ask whether something could fail, wealthy people ask what happens on average across all possible outcomes. They hunt for asymmetric opportunities, size their bets to survive losses, and understand that calculated inaction is often the riskiest choice of all. This framework works in every market, every industry, every situation. The only question remaining is whether you'll actually use it.